All right, welcome to The Explainer. You look at the stock market right now, and things look amazing, right? But what if it's all just a big illusion? Today, we are going to dig into an analysis that's warning of 3 huge bombs just waiting to go off under this boom, potentially leading to a major crack in 2026.
I mean, look, right now the market is absolutely euphoric. The S&P 500 is just shattering records left and right. You've got major banks throwing out these huge predictions, saying it's going to go even higher. The feeling on Wall Street? Pure ecstasy.
But what if this whole thing is just dancing on a tightrope? What if everybody is just looking in the wrong direction? The analysis we're breaking down today makes a really compelling case that underneath all this celebration, there are some huge problems piling up, and most people, they don't even see it.
Okay, so let's get right into it. The market's hidden dangers. We're going to start by looking at this illusion of a super healthy economy and, why those big headline numbers might not be telling the whole story.
So to really get what's happening, the analysis brings up this idea of a K-shaped economy. It's actually a perfect way to visualize it. Just picture the letter K. That top arm shooting upwards, that's the tech sector, that's AI, it's just exploding. But that bottom leg, the one pointing down, well, that's pretty much everything else. We're talking manufacturing, we're talking small businesses, the real economy that most of us live in every single day.
And this chart, wow, this really drives the point home. So check this out. In 2025, the U.S. economy grew by $500 billion. And that sounds awesome, right? But here's the kicker. A staggering 80% of that growth, that's $400 billion, came from one place and one place only: companies spending on AI. The rest of the economy, it barely even budged. It's insane.
The source we're looking at uses this brilliant analogy. It says it's like a classroom, where you've got a couple ingenious kids who get 100 on the test, but almost everybody else in the class is failing. The class average, it looks pretty good. But the reality is, most of the students are in big trouble. And that's the economy right now. It's a massive boom, but only for a tiny, tiny slice.
Okay, so what's the first one of these ticking time bombs? Crack number 1, the AI bubble. And look, I get it. You're probably thinking, wait a minute, AI is the future, and you're absolutely right. But believe it or not, that's kind of where the problem starts. And this is such a crucial point. We have to separate a great world-changing technology from a good investment. Think about the internet, right? It totally transformed our lives, no question. But if you were one of the people piling into internet stocks back in 2000 at the very peak of the dot-com bubble, well, you probably lost everything. A great idea doesn't automatically mean it's a great investment at any price.
This reminds me of that classic quote from the legendary investor Peter Lynch. When everyone believes something will only go up, that is when you need to be careful. And boy, does that feel relevant right now. The moment of maximum hype, when nobody can see a downside, that, he says, is the moment of maximum danger.
And we're not just talking about hype. We are talking about serious, serious money. Get a load of this number, $399 billion. That's how much the top tech giants poured into AI in 2025, in a single year. It is an absolutely colossal bet on the future. But as this analysis points out, it is a bet with no guaranteed return.
So, why the skepticism? Well, the analysis flags 2 potentially fatal bottlenecks for AI. The first one is, believe it or not, electricity. These data centers are power hogs, and they need way more juice than our current electrical grids can actually supply. It's a huge problem. And the second bottleneck? Monetization. I mean, where's the killer app? How are companies going to turn these trillions of dollars in spending into actual, real-world profit? Right now, nobody seems to have a clear answer.
All right, let's move on to the second potential crack. This one's called the credit iceberg. And that's a perfect name for it, because just like an iceberg, the part you can see is nothing compared to the massive danger lurking just beneath the surface. So, how big are we talking? $3.5 trillion. To put that into perspective, that is a mountain of debt bigger than the entire economy of countries like France or Canada. And the really wild part, this whole market is operating in the shadows, outside of the normal, regulated banking system.
And that's exactly what makes it so scary. It's a total black box. Since it's not really regulated, nobody, and I mean nobody, knows how risky these loans really are. The analysis draws a really chilling parallel to the subprime mortgages that blew up the global economy in 2008. It's this hidden risk, a ticking time bomb, and we have no idea how short the fuse is.
Okay, let's talk about crack number 3, the valuation reality check. I mean, how can we tell if the market is truly overheated? Well, the analysis uses two classic historical indicators that have a scarily good track record of, let's just say, flagging trouble ahead.
First up, we have the Shiller PE ratio. Now, this is a way to measure market valuation that smooths out the short-term noise. Right now, it's sitting at 40. Now, let me tell you why that number should make you sit up and pay attention. In the last 140 years, it has only been higher once, at the absolute peak of the dot-com insanity. Yeah, that's how stretched things are. And if that wasn't enough, let's look at the Buffett indicator. Warren Buffett himself called this the best single measure of where valuations stand at any given moment. A normal, healthy reading is somewhere under 100%. Where are we today? 222%. That's not just high, folks. That is completely uncharted territory. We are literally off the map.
So, after hearing all that, you're probably wondering, okay, what am I supposed to do now? This next section is all about preparing for the storm. And the analysis is really clear on this point. The goal isn't to panic and try to time the market. That's a fool's game. The goal is to be strategic and prepared. So here are the 4 big, actionable steps the source recommends. Step 1, audit your portfolio. Seriously, take a deep dive and ask yourself, am I holding quality businesses or am I just riding a wave of hype? Step 2, stockpile some ammunition. And by ammunition, we mean cash. Step 3, focus on intrinsic value. Learn to see what a company is really worth, not just its flashy stock price. And finally, step 4, never stop learning. In markets like these, knowledge is your best defense.
And hey, if you think holding cash is for losers, just take a look at what the master himself, Warren Buffett, is doing. In late 2025, he was sitting on over $380 billion in cash and short-term bonds. Now, is he scared? No way. He is being patient. He's waiting for the storm, because he knows when it rains, you should catch gold in a bucket, not a thimble.
And this really gets to the heart of the entire analysis. The word crisis implies 2 things. Danger, yes, but also opportunity. A market downturn isn't just about losing money. For the prepared, it's the single greatest opportunity to build real generational wealth. It's when the best assets go on sale.
So ultimately, this analysis leaves us with a final, very personal question. A crisis creates opportunity. That's a given. The real question is, will you be ready to seize it? Are you going to be the one panicking or the one with a plan?